If you are investing money today, you are looking at a hard fork in the road. On one side, the immediate gratification of passive income. On the other, the mathematical weight of long-term compound growth. The left side shows the dividend dream. It's tangible, regular checks hitting your bank account, proving your money works. On the right, the index engine. You trade immediate payouts for an aggressive, compounding upward curve that snowballs over decades. Financial influencers heavily market both strategies. As a result, everyday investors get caught in the middle, hopping back and forth between the two, and building chaotic portfolios that fight against their actual financial goals. Getting this wrong has exact consequences. Pick the wrong approach for your specific timeline, and you will either trigger thousands in unnecessary taxes during your peak earning years, or you will run out of liquid cash in retirement. To determine the mathematically correct choice, we are going to run both strategies across a strict 25-year timeline, judging them solely on the metric of total return. To do that, we have to strip away the emotional attachment of having cash in hand and look closely at the cold math of wealth. This comparison matrix shows exactly how these strategies perform against each other. Let's look at the first row, diversification risk and total return. Building a dividend portfolio means you are intentionally filtering the market. You are concentrating your money into mature, established companies that have surplus cash to pay out. The outcome is exactly what you sign up for, a satisfying, predictable stream of cash deposited into your brokerage account. But by strictly filtering for yield, you actively exclude the fastest-growing sectors of the economy. Modern, high-growth companies rarely pay dividends because they reinvest every spare dollar into their own expansion. Because they prioritized monthly cash, dividend purists completely missed the explosive capital appreciation of companies run by founders like Jeff Bezos and Mark Zuckerberg. For decades, those businesses shunned dividends to fund massive internal growth. A broad market index fund like the S&P 500 eliminates this blind spot. It automatically captures both the slow and steady dividend payers and the aggressive tech engines, requiring zero stock picking on your end. The math here is rigid. Sacrificing total market exposure to guarantee monthly cash flow statistically caps the ultimate ceiling of your portfolio's return. We need to drop down to the second category in our matrix, tax efficiency, and a hidden mechanic called tax drag. When you hold individual dividend stocks in a standard account, the corporation forces a cash payout onto your balance sheet, and they do it on their corporate schedule, not yours. The moment that money hits your account, it triggers a taxable event for that specific calendar year. Many investors assume that immediately reinvesting that cash back into the stock avoids the tax. They do not. The IRS requires you to pay taxes on that distribution regardless of what you do. This line chart demonstrates exactly how tax drag suffocates your wealth over 25 years. The top line is pure compound interest. The bottom line shows how an annual tax subtraction peels away your returns, creating a massive loss in total wealth by year 25. Index funds sidestep this problem. The majority of your wealth stays locked inside the fund as unrealized capital gains. It compounds in the dark, completely tax-free, until the day you personally choose to hit the sell button. If you are currently in your peak earning years with a high income tax bracket, being forced to absorb dividends creates a persistent friction that destroys your long-term wealth potential. Let's fill out the final categories in our matrix: time, effort, and the psychological reality of managing this money. First, we have to clear up the most expensive illusion in the dividend space. A dividend payout is not free money magically generated by a generous corporation. This bar chart shows the actual mechanics. On the day a cash dividend is paid out, the stock share price drops by the exact amount of that dividend. You haven't gained anything extra. You simply moved money from your investment pocket to your cash pocket. To keep that cash flowing safely, you are forced to actively manage the portfolio. You have to monitor quarterly earnings, track corporate payout ratios, and constantly monitor the horizon for unexpected dividend cuts. A broad index fund is a completely passive vehicle. You set up automated contributions, buy the entire market at once, and walk away. The psychological hurdle for index investors is that the wealth feels entirely abstract. It sits silently on a screen, denying you the immediate dopamine hit of seeing a fresh cash deposit clear your bank account. Building a custom dividend engine demands a heavy tax on your mental energy for a strategy that historical data shows will underperform a passive index fund 90% of the time. Since both strategies carry specific trade-offs, the winner depends entirely on your timeline. This decision tree maps out exactly where your money belongs. Look at the starting node here. Let's follow branch A down to the left, optimizing for maximum long-term net worth. This path belongs to the wealth maximizer. You are currently in your peak earning years, and you have at least 10 to 15 years before you plan to retire. If this is you, the math is solved. You should allocate your capital heavily into broad index funds to capture tax-efficient, compounding growth. Your necessary trade-off is patience. You must ignore the appeal of monthly passive income today to secure a mathematically larger total net worth in the future. Now, let's trace branch B down to the right, optimizing for immediate cash flow. This path belongs to the yield chaser. You are either 0 to 5 years from retirement, or you have a strict need to replace your salary with passive income. In this scenario, transitioning your assets into dividend-focused strategies is the correct mechanical move. You accept a lower ceiling on your total growth, but in exchange, you buy the psychological safety and logistical ease of knowing exactly how much cash you will receive every month to cover your living expenses. You transition to an income strategy after the wealth is already built, not while you are in the trenches trying to build it. Neither investing style is wrong on its own, but choosing a strategy that actively fights against your current stage of life is the most expensive mistake you can make.